Your ability to effectively run your business or investment fund comes down to many things, but the main one is your own self-awareness. Join me and my friend Jim as we chop it up on how he built a $250 million real estate fund, and you're going to want to tune into the end where we go really deep. All this and more coming right now. Let's get into it. Hey, welcome to another episode of Making Billions. I'm your host, Ryan Miller, and today I have my dear friend Jim Manning. Jim is the founder of multiple funds in the real estate and debt space. He's managed and sold over, get this, $250 million in real estate, and this guy is just getting started. So what this means is Jim understands real estate funds, debt funds, and how to manage large conglomerate companies. He's about to give you a masterclass on both. So Jim, welcome to the show, man.
Ryan, thanks for having me, man. I'm really excited to be here. And the Making Billions podcast is one of the few podcasts that I've actually listened to multiple episodes and really have enjoyed. And it's really the mission of what I'm trying to do. I'm trying to turn myself into a multimillionaire, into a billionaire, actually. So what a great community, what a great mission that you have to help us millionaires turn into billionaires, right? So thanks for doing this.
You're welcome. It's so great to have you. And yes, we're all brothers on that path, man. We're on our way, and we're trying to bring as many people with us as possible. And we've risen to the top 2% in the world, all because of amazing guests like you. So we're certainly honored to have a man of your caliber. And really quickly, just maybe 30 seconds, just bring up to speed. What are you up to? What's Jim's world? Bring us up to speed before we address the beginners.
Yeah, absolutely. So I've founded 5 real estate companies, 4 of which are run without me. And the biggest thing that I work on now is a real estate fund that helps people buy and hold on to real estate. We have a special niche in the lease purchase department strategy that helps us put the tenant in the place of a homeowner and pay for all the repairs and maintenance. And we get just cash flow real estate with a group of us. So yeah, that's the thing that I spend a lot of my time on now. I have a podcast called The Passive Wealth Show, where we talk about passive investing and what are some strategies and good ways to generate passive income without doing any of the work as well.
Yeah, and I love that. So, for the beginners out there, people who are looking at you or myself or anybody that are just like, hey, I would like to head in that same direction. So for people who are just starting out, really feeling that bug of inspiration, you and I have been there before too. We were younger men, and we thought, you know what, that'd be cool. I think I'm going to pursue this career path. For your career path, real estate, passive investing, debt funds, all of this thing, you're really on fire, bro, and you're just getting started. What would you tell beginners in the early days, if they're investing in real estate or whatever it might be? What would you tell them on A, how to win, and B, how not to lose? What would you say?
Absolutely. So for right now, there's a strategy called creative financing in real estate. That's incredibly powerful. And it's something that I would definitely be focused on if I was looking to do my own deals, because 1, you could do deals without any of your own money. And then 2, it allows you to leverage interest rates as assets. So what I mean by that, like you can go to a homeowner that has, say, a 3% interest rate, and you can say, hey, what price do you want for this home? It's a $300,000 home. I'll give you $300,000 for this property if you give me a better interest rate than what I can get on the open market. And a lot of people don't realize that you can sell your property and maybe, let's say, sell it at a 5% interest rate. If the property costs you a 3% interest rate, then you can make a profit. You can turn a house sale into passive income. We did that with actually a fraternity brother of mine named Devin, and I was able to get him exactly what he wanted for his house. And he was able to go from a $300,000 house to a $500,000 house. His monthly payment actually ended up staying the same. So he almost doubled his price point and didn't have to pay any more per month by making this move. And it's all because I've studied and I understand what creative financing is, how to buy properties subject to, and how to have a owner finance the property. So I get it, especially if you're a beginner. I'm throwing a bunch of industry jargon out at you. It's a really powerful market opportunity. And regardless if you even want to get into real estate investing or not, if you own a home at that lower interest rate, try and remember that. Your mortgage is an asset now that interest rates have gone up. And don't just sell your property a traditional way. You can sell it and then make some passive income by doing some creative deal structuring.
Man, I love that. And so that's some powerful way on how to win. What about how do you avoid losing and just some of that downside risk in the early days? What would you say?
Yeah, I think one of the keys is controlling the exit strategy that you use. So when we were flipping properties like you see on HGTV, we would buy a property, we would fix it up, and then we would sell it all within a 3 to 6 month span. And when your exit strategy is that tight, we had to be perfect on the construction budget. We had to be perfect on what our after repair value was. And if the market would shift at all, our profit margin could go from making $80,000 to $50 or $50,000 to 20, or if it was a thin deal because it was a lower price point, even down to break even. And so in real estate, a good rule of thumb is the shorter the exit strategy, the more risk you're taking. The longer the exit strategy, the less risk you're taking. So if you think about 2006 to 2008 to 2009, the market went down about 20%. Well, if you bought a rental property in 2004 and you owned it 20 years later and you owned it today, you're probably feeling pretty good about the investment, even though you maybe bought it and the market went down a little bit for a few years, because the market over time ends up appreciating, right? And then one of the ways, like as I mentioned, my friend Devin, what we've also been able to do on deals like that is we go to a homeowner and we say, hey, we'll buy your house creatively. And we like to sell properties on a lease purchase strategy. If we can't find a lease purchase tenant, we're not going to execute on this contract. So it's contingent on us finding the end buyer for the property. So that's a way to get a property for no money. And then also, if with the right contingency in there, only do the deal if it's already sold on the back end. So there's ways to do it to dramatically lower your risk and make it really, really hard to lose.
Man, I love that. So really, just when you're starting out, learn to leverage the power of creative financing to get some early points on the board, right? So it's relatively affordable. So you don't have to have millions of dollars to start, but you do it right, you just might end up with a few bucks in your pocket. And then, you know what? There's always risk. You're an investor. Absolutely. We're not giving financial advice, but we're just saying from Jim's experience, what we can say, learn that exit strategy. Really understand what it is that you're up to, and all of those dynamics. Working with those two things will definitely give you a great launch so that you can be a fund that has one too. So moving on to the market, what would you say as far as where it's at? What are you seeing out there right now? And then maybe we'll talk about where you think it's going.
Absolutely. Yeah. So when we talk real estate, I want to do the caveat is like, anytime you hear blanket statements, it can be dangerous because real estate is so local, right? So there's going to be exceptions to this and different pockets that will behave different. I think it's really important to understand the macro trends, then also make sure you align yourself with someone that has a special localized knowledge with the market that you're into. Okay. So for this purpose, let's get specific here. I'm going to talk single family real estate. I'm not going to talk commercial. That's really my area of expertise. And then we're going to just talk on a macro level, what's happening in the United States, not necessarily what's happening in California versus New York or anything like that. And what's interesting is that interest rates recently went up quite a bit. There was a lot of uncertainty that entered the marketplace, and a lot of people were like, oh, I don't know what's going to happen. I don't know what we should do. Maybe we should just kind of sit on the sidelines a little bit. The knee jerk, I think, with that is, oh, well, if interest rates go up, home prices are going to just go down because the cost of money is more expensive. So the asset's worth a little bit less. The interesting thing is if you actually study the statistics, there is no correlation between rising interest rates and what home prices do. Sometimes when interest rates have risen over the last 50 years, home prices have gone down. Sometimes they've stayed the same. Sometimes they've gone up. The single biggest driver on what the housing market's going to do is actually the amount of buyers to the supply of houses. And that supply and demand has much more of an impact than what interest rates are doing. So what interest rates do, though, is they shrink the amount of units that are sold. If a market's used to selling 1,000 houses a year, maybe it's going to sell 800 or 600 houses that year. So it does slow it down, but slowing it down doesn't necessarily mean home prices are going to get worse. So as far as the market goes, let's talk about the demand. So NAR did a study that over the last 10 years, there was an extra 5.5 million houses that needed to get built that just weren't. We're in this housing shortage. We're in this housing crisis, is what before interest rates went up, everyone was calling it a housing crisis. And the number that's interesting that people don't talk about as much, and I spent hours and hours and hours researching this because we're making investment decisions. We're buying millions of dollars of homes a year. So, I wanted to feel confident on whether we should be buying right now or not. So I did a ton of research on this. I found a study by Harvard that suggests that there's another 21.7 million homes that need to get built through 2038. And the reason is that Gen Z and millennials are the biggest demographics right now. They're in their peak home buying years. So 5.5 million houses should have been built. Another 21.7 houses need to get built. That's right around 27 million houses through 2038. And there's a slight problem. Who's going to build them? So I was talking with my friend, his name's Gary. He has 40 years of new construction experience here in St. Louis. That's the market I operate in, St. Louis, Missouri. I said, hey, how are you guys doing? What's going on? And he said, well, our company has 500 employees in it. We have enough demand for 1,000 people to keep them busy all day without even thinking about it. And I can't find a 501st person to hire. I don't know where they're at. There's no one to build these houses. So with these supply and demand challenges, I think it's a pretty logical conclusion to realize that home prices aren't going anywhere. We don't know how steep they're going to appreciate, but we certainly can feel very confident that they're here to stay for a little while.
Man, wow. So there's a big short supply in all of those by the sounds of it, and a large demand. So we've got a problem. And typically when there's a shortage, large demand, short supply, prices go way up. So if you want to be an investor, that can be somewhat challenging if you're just starting out. But as you get going, a lot of appreciation, especially in that single family space. Would you say that's a fair summary?
Yeah, absolutely. And the strategy we're doing is we're trying to just buy and hold. And think of it like a big land grab, right? Like we're just trying to buy and hold as much as we possibly can right now. And there's a lot of fund structures out there right now that are trying to do the same thing, by the way. There's Vanguard and a couple of the other bigger players. There was a study that was done by, I think it was MetLife Insurance, where they're estimating that the bigger funds are going to, own 30% of all single family real estate by 2030.
Wow.
And, those funds out there that have their analysts, they understand what supply and demand can do to pricing too, right? It's like the wild, wild west or something. It's a shame because the American dream, something that's really important to me. I think owning your own roof and owning your own roof is a really important thing to have that pride of ownership. And unfortunately, affordability for starter homes, I don't see it getting better. It's going to continue to be a challenge, for the next couple decades. And this is my crystal ball. It's as good as anybody's, I suppose. But it's hard for me to imagine a scenario where affordability gets better.
So would you say that maybe looking forward, based on that, where the market's going, I'm putting myself in a Gen Z millennial position, be like, how am I going to afford this? Well, one, you were originally talking about owning your own home, but maybe as an investor, which you are, which I am, maybe there's more syndications. Do you see, as you look into your metaphorical crystal ball, do you see more syndications on the horizon, or where do you see the market going from 2024 and beyond?
Yeah, I really think the syndications, the fund structures are really going to continue to be a big player and create more and more competition and more buying demand for these properties that, quite frankly, a lot of the inventory is irreplaceable right now. You can't build a $200,000 house starter home anymore. Inflation's price and lack of labor and labor shortages have priced that out now. So to me, it's an amazing investment opportunity to just buy and hold on to a fixed inventory that cannot be replaced. Yeah, we can start getting creative and doing tiny houses. Yeah, Elon or somebody might create some robots that help build houses. These are all potential solutions that entrepreneurs can come up with, but I don't see robots building anything in the next couple decades. That's figure that out and then to get it going and put millions into it and everything like that, right? What are you seeing, Ryan, on this? What are you thinking?
All I was thinking was I'm looking forward to the day when I just drive by and see robots building neighborhoods. So I'm on the venture side. So of course, robotics gets the blood pumping for me. So yeah. But we see, in all seriousness, though, so I pay attention to interest rates. So we might see some softening. I know inflation actually started to tick up again. That just came out recently, maybe today. So we see inflation still climbing up, rearing its head. So yeah, that's going to be tough. This is really, really hard for regulators to do. As the saying goes, being a regulator is a hard job, and they just keep tapping on the brakes till something flies through the windshield. So they're still tapping on the brakes a little bit, trying to get that interest rate right. But as you know, I'm sure anyone in a highly levered product in real estate or private equity, this is going to be a bit of a challenge for them. It's not a destroyer of worlds, but definitely we got to switch our game up. So we're going to see a lot of investment funds in the world that you and I operate in, Jim. A lot of people in highly levered products are really going to have to might shift their thesis or their strategies or just how they calibrate their portfolios. That's going to be increasingly more important on these highly levered alternative assets. Now, hopefully 2025 is going to have some softening there in 2026 as far as these highly levered interest rate dependent type of industries like yours. Hopefully by then we're going to see a nice ramp up, but maybe less spicy with inflation. So hopefully we'll see some nice growth without breaking Main Street.
Yeah, it's amazing doing this as long as I've been doing it now, 17 plus years. Like the hustle just changes. Like when interest rates were low was the last thing in the world you had to think about trying to get the lowest interest rate possible or whatever. And now, the interest rates are up. So now maybe you need to go talk to start negotiations with three different banks, or, to try and get every little penny you can. And every market has different challenges,
Yeah, I thought a lot about this, and you see Jamie Dimon, so talk about, traditional banking, a lot of regulations coming out that traditional bankers are upset because it's going to push a lot of people into private lending. So you might see a pickup in private lending given these regulations. You also might see some tax incentives. So if the interest rates are high, so if whoever's in office is in charge of that, if we're seeing high inflation, they're going to hammer the crap out of it with high interest rates, right? They're going to get that down. However, if you leave that alone, you have not fixed. In fact, you may arguably have made this housing shortage worse. And so what you may see is simple things like a lot of industries, taxes are always a great lever to influence industries. So you might see some accelerated depreciation things come online for anyone who wants to be a builder or an investor who builds homes. And so there may be some help, but it's going to take a while, because they can't just keep, hitting the interest rate button over and over and expect all of the economic problems to go away. It will solve, and it typically is good for solving runaway inflation, but it could pick up problems in different areas. So you may see a combination of high interest rate, but also tax incentives for specific industries. So I would look at those two things. So not just highly levered, but also what are the tax incentives? And this, my friends, so we talked about changing structure as you respond to that. Jim, you asked my opinion. So we're going to let it rip. You may see a lot of different tax incentives. And this underscores the change in fund managers, fund structures, or alternative asset managers. Is now we can say you can have an okay investment thesis, an okay offer that is supremely well structured, that is very finely tuned to the most modern tax incentives, and you might be able to pull out some alpha. So that's what I hope for. And I know hope is a horrible strategy. So it's not a strategy. I'm just saying they got a lot of headwinds. So you're going to see interest rates go up to hammer that. And you may, cross your fingers, may see some better options on the tax front to better structure, or just invest in existing ones and expand those out, like 1031, opportunity zones. There's a lot of other incentives through venture capital. But again, if you're in a highly levered product, structure in a high interest rate environment matters. Would you agree?
Not only do I agree, but that is why what we just heard there, ladies and gentlemen, is why I call you and get advice from you every chance I possibly could get. That was very well said. And I have learned there's things I'm really good at. We know investing, we know advanced real estate investing strategies, but what the nuance of what you just described there, my goodness, I have to have the right people around me, because that, I can negotiate a creative financing deal on real estate all day, but that's that type of stuff. Jimbo needs some help.
All right. You got it. Before we hit record, I promised you I'd use big words and try not to embarrass my mother. So there we go. So this is awesome, man. Thank you for watching. If you've made it this far, we must be friends. So don't forget to like, subscribe, and click that notification button. Now, let's get back to the show. So that's our market prediction, folks. It's Jim and Ryan. We're just shooting the breeze, just giving our friendly opinion here. But we're not done yet, my man. So you've been doing this a while. I've been doing this a while. And I'm really curious, if you had to start over or anything at all, if you just summarize. If someone's like, dude, give me in 5 or 10 minutes, just tell me the most effective stuff. Summarize in 3 points. What have you found from all of your experience that you can leave for our listeners to help them to gain a competitive advantage from you? What would you say?
Yeah, absolutely. What a great question. So the first thing is, I would call it like finding your honey hole, finding that right niche that meshes with where the market's at. And what I mean by that is so when I first started out in real estate, short sales were half the market. We got really good at doing short sale deals. And what a short sale deal is, for those of you that don't know, is if a bank has a loan on a property is $200,000 and it's worth $100,000, it's talking to the bank and saying, hey, will you agree to sell the property short of the loan amount? So we got really good at that. It was within our natural skill set of running numbers and being investors. That if you fast forward to today, short sales are non-existent because people have more equity than they've ever had. When I talk about finding that right niche that meshes with today's market, it's having an awareness. There's not every strategy, not every business model is created equally. And whenever I've gotten out of what the market of the moment is, has felt like I'm like pulling teeth, and I'm trying really hard, and I'm making some profit, but I'm just not quite making as much as I feel like I should. And whenever I'm into a market, like we got into the lease purchase model. That's one of our real estate funds. We put a property up and we started marketing it, and we had two different tenant buyers fighting over the property. One offered us $30,000 before they moved in on day one. The other offered us $40,000. It's a lot easier to make money when you find a niche and a market opportunity that's underserved and has crazy demand. That's something that I've learned the hard way. That I didn't have an awareness of how important that is until, it's taken me 17 years to really understand that and become aware of it. And the other part of it is it's a combination. It's not just what the market opportunity is. There's also an honesty part to it. I think you need to be brutally honest with like, hey, what's my team good at? What am I good at? What are my strengths? What am I not good at? Is this something that can financially drive my business? And when I get brutally honest, and then there's a sweet spot that happens when you mesh something you're really good at with a market opportunity that's underserved, and you're solving a problem that has a lot of financial upside. My goodness, the magic happens. That is, Ryan, how you go from a millionaire to a billionaire, where you're able to solve a problem for a niche like that. It's underserved. And when you hit it, it's just like putting gasoline on the fire. And it's not like pulling teeth. It's like, oh my gosh, like we're dealing with scaling up problems right now. Like, oh my gosh, how do we raise $6 more million for our deals than what we did last year? And last year we raised double the amount of money we had ever raised ever before. But we've hit a nerve, we've hit a demand, and it's not like pulling teeth. It's like, oh my gosh, we've caught fire. Does that make sense, Ryan? How important that is?
Absolutely.
Have you ever had some of the same experiences with any of your businesses? Have you fought a market versus really got in sync with one?
Yeah, fighting a market is never good. As they say, the trend is your friend, only if you're on the right side of it. If you're not on the right side of that trend and the market's moving in a direction, you're moving in others, that's really hard to do. Now, it's not impossible to make money because we have a word for that, and that's called contrarian investors. It's basically betting against the market. But that's not enough. You actually got to be right. Imagine that. So it's not enough just to be a rebel without a cause, to be that contemptuous, which I am at sometimes. But however, you really want to make sure that when you're going against the market, you got to be right. And that's hard to do, right? Because emotionally, you're like, am I crazy? Maybe. I don't know. What am I doing? And so going against the market. Now, working with the market, especially in venture capital, but this goes in any kind of fund that you're working on, it is so important to align with the market. In VC, we call it product market fit, right? So we got to be like, cool. So you can build a thing. You could probably make money at this thing, but do people want it? I don't know. And so really understanding that, is there a market, which may not be the market, like you said, it's regional. Is there a market that is very welcoming, accepting, and looking for our solution? That's typically where I like to go. I'm a rebel at heart, but at the end of the day, the trend is my friend. We try to find what those are and make sure that there is some desirability for what it is we're putting out to the market. So that would be my approach.
Yeah. And I get it. That's not what you said isn't easy. I mean, that's what solving problems is. That's what being an entrepreneur and a business owner is. And I promise you, when you find that nerve, our properties, or at least purchase deals, we're getting over 70 inquiries on every single one we put in. And there's 5 amazing people we could put in these properties. And gosh, I would love to tell you I was smart enough to learn this lesson that we're talking about here, guys. Like when I started out, I've learned it the hard way. And every time we start to get a little stuck, it's like, okay, has the market shifted a little bit? Do we have to pivot a little bit? It gets, what's that saying? A rising tide raises all ships. Like a rising market raises all ships. And you can be there's certain markets when they catch fire, you can be a very average company and make millions and millions of dollars just because you hit the right market at the right time.
Yeah. And as the saying goes, Jim, the riches are in the niches, man. So I like what you're talking about, is just finding that niche. So
absolutely.
So the first one is just finding that niche, that market fit, finding where those riches are. What else would you say if you had to start over, or have somebody ask you to summarize your best advice?
When you're hitting a ceiling of achievement for your business, we talked about the market, so that's a component of it. There's also how you've structured your business. And businesses go through different ups and downs and ebbs and flows. But to grow and scale, there's certain bottlenecks that you'll inevitably come across. One of our first ones, so when we first started out, we were able to grow our business to do 3 property flips at a time, which for a 24-year-old when we were 24 and 25, I'm pretty proud of that. What we were doing was we had a private lender that was lending us 100% of the purchase price. And then Ryan, the co-founder with us, and me, Ryan Wessels, and myself, we were out of pocket funding all the repair costs. Okay. So we were able to make profits, and then we reinvest those profits so we can then scale and grow and start to make more money. And that was great. And we were very restricted within that model. So we wanted to do more deals. And as we were thinking about it, I thought, well, we're getting 100% money from our lenders. They trust us with that. I wonder if they would trust us to just give 100% of our repair money. Why don't they just give us 100% financing on everything? And we talked to the guys. They had already been lending to us for a number of years. They trusted us. We had always done what we said we were going to do and gave them the returns we promised. We've done that for 17 years now, by the way. It's one of my really proud achievement. But then what was amazing about that was the bottleneck that we had with the amount of deals that we could do was restricted. The amount of money that we had suddenly became, we can do infinite deals if we can raise infinite capital. So we're only restricted now by the amount of capital we can raise. And that's a whole lot faster to do that than to take 6 months or 12 months to do a deal, take those profits, put it into another house, and then build it that way. And we went very quickly from doing 3 deals at a time to about 6 years later, we had 120 flips going at the same time. This was back in 2017, I think, that we had that many properties going. And that was just such an amazing, that was such an amazing learning opportunity for myself that a lot of times it's not work your way through a problem to scale up. It's think your way through it and take the time to not just do. It's okay, wait, what's going on? What is the hidden bottleneck that if I just thought about my business a little bit that I need to remove, that I need to clear out so then the team can kind of get to the next level. They can grow to the next heights. So I try to do that now. Like, hey, the billion, we're working on growing our companies into $1 billion organization. What's getting in our way? Like, what do we need to do to unlock the greatness within this niche that we've stumbled on and that we can rock and roll on?
Man, I love that. Yeah. So really asking effective questions. And that says, you've been doing this for nearly 2 decades. Asking a better question gets you better answered. So I loved exactly what you just said. You said, look, what is stopping us? I know the vision. I planned the vision. It's $1 billion. It's more of a goal, but either way, I'm sure there's a vision attached to it and it's amazing. But if with that goal, whatever that is, we're just like, what's standing in our way? Real talk. And so the great thing about not only making billions, but also leadership. And this is something we don't talk a lot about, but also in that leadership, scaling bottlenecks could be leadership, but it could also be propellant too. It could be really good. And so asking that through effective leadership is just ask better questions, right? Jack Welch was known as that, right? So you would walk around and ask people questions, be like, hey, what are you doing? I used to do that. I'm still a recovering CFO, so I'm still in recovery, but I'm making it through with the proper medication and therapy. I think I'll be just fine in a few years. But in all seriousness, what I would do the similar thing. I had no idea Jack Welch would do that. But going around and just asking better questions. That's exactly what you've done. And by asking better questions, folks, if you're a leader or you aspire to be, don't ever set the precedent that you have all the answers. In fact, if you're good and you stay close to your team, just like Jim demonstrated, he would ask, what's standing in our way? You'd be surprised. Through effective leadership, you can get the answer.
I love that you share that, Ryan, because it actually reminds me of one of the biggest leadership flaws that I've had to overcome. I don't know about you guys, but for me, I took the visionary test. I'm a 98% visionary. Visionaries had all this strategy and all these ideas, and I had a lot of my personal worth tied in that I was the guy that had the idea, and ego will kill a company faster than anything. And what Ryan said was so powerful was, hey, he would ask the questions and let the answers come from the guys doing that function every day, tapping into the brilliance of the team. There can be an idea that maybe Ryan or I could have for a company, and maybe it's a little bit better than what a team member would have. Hey, let's just stroke our egos a little bit and say it's a little bit better. But if that team member doesn't have buy-in because it wasn't their idea and they don't truly own it, the execution of it will likely be far worse than if it was their idea and not quite as good, but they have 100% ownership of it to be able to take it and put it into the company and grow. And that was, that had, we talked about bottlenecks earlier. We create our own bottlenecks as leaders often. And that was one that really was a massive blind spot for me till we hired our current COO. I didn't see it. I didn't realize that how many problems I was creating because of that. It hurt my ego quite a bit because I had to take a step back and realize that I was trying to be this know-it-all and I was masking it as, I'm just trying to contribute. I'm just trying to help others or help the company when Yes, the intentions were probably good. And at the same time, trying to make myself feel pretty good and be the guy with all the answers. So yeah, thank you for sharing that. I mean, that is something that I think holds more leaders back than just about anything. I know it will be back.
Yeah, you reminded me in an earlier episode, I talk about the 5 things in episode 100, the 5 things that hold us back. Very often, we, like you said, stand in our way. But one of the things that we talk about, and this was a big one, for those of you who are listening to me and Jim, we're both executives, we're both CEOs, we run our own funds, we do all these things. Sure, we're busy, but we're really trying to make a difference. But one of the things that I would challenge many of you, first of all, go listen to episode 100, but if not, let me summarize it. Remember, really check on yourself. You can't tell me and Jim and I are being very vulnerable right now as executives. We're also human beings. When you're doing something, check inside of yourself. Are you doing it for love or from love? It's the difference. Often, as executives, we'll be like, I'm doing it from love. I love my people. They're awesome. They're amazing. I love my team. They really do. But sometimes you can get caught in that place. And I'm not saying anyone, you or me or anyone, Jim, who are doing that, but I'm just saying challenge yourself, because often we're humans. We like to be liked. And often we do these things out of obligation, trying to get love or approval. That typically doesn't end well. I don't know about you. It's never ended well for me. But when I come from a place as a leader, and I come from a place of love, rather than doing things from a place for love, it's a complete game changer. And people notice it without realizing they're noticing it. That you can feel the authenticity of leadership. So what does all this mean? It goes right back to what Jim's talking about. Identify the bottlenecks, even if that is you, especially if that is you.
It's most likely you.
It's most likely you. Yeah. All right, everybody, it's your fault. Just own it. Just take that one on the chin. Just take it all. But that's the extreme level of ownership. That's what leaders have to do. You have to be above the rest, not in the ego or your self-worth. That's not what we're talking about. We're just saying your standards need to be high, and you have to have that extreme level of ownership and accountability on yourself to make sure that you've tended to the garden, the soul. Make sure that things that come from the inside out really do demonstrate a lot of value and create that. Leadership, my friends, can create a ton of value. So identifying those bottlenecks, if it's you, if it's your leadership team, if it's the way your corporate structure, I mean, there's a lot of ways. But I think what Jim is saying is don't forget to turn that magnifying glass on yourself as a potential possibility as a bottleneck. Let's just assume you are the cause of some bottlenecks and then work backwards from there. Would you say that's a fair summary?
It's an eloquent summary.
Thanks, brother. Awesome, man. So I teased you with 3 items. I know there was a time early in your career you shared with me, and I was wondering maybe for the third one, if you wouldn't mind sharing, since you're on Making Billions, the time that you had a fortunate opportunity to work directly with a billionaire. Maybe share that.
Oh, okay. Yeah, great. So, it's a perfect topic for this because if you're listening to this show, you're crazy enough to have that goal, like the pinnacle of business achievement, building a business into a $1 billion enterprise. As a 22-year-old, as luck would have it, I ended up getting a side gig for a self-made billionaire. And so what I did was I worked for him for 2 weeks, and I would take a bottle of wine out. I print out a label and I put the what the wine was and like how much it was worth. I put a little sticker on it and I put the wine bottle back in. At one point, I was flying on his private jet, drinking a $1,000 bottle of Krug champagne. And unfortunately, I had just graduated college at the time. So I wasn't sipping it and enjoying it. I was just chugging it. So if I could give my 22-year-old self some advice, enjoy the $1,000 bottle of champagne. Don't chug it like that frat guy. And like the amount of this wine collection, at one point I had 250 grand in my hands, and it took me and 2 other guys, the 3 of us, 2 full weeks of taking a bottle out and putting a sticker on it and putting it back in. That's how much wine this guy had. And as a 22-year-old, it's like, whoa, this guy's incredible. Like I had no idea. I'm from a middle-class family, and I didn't know this existed. Like America lets you do this. This is unbelievable. I went to his pet house. I met his girlfriend, which was more attractive than any girl I had even thought entertained. And I was a collegiate athlete. I was in great shape, but just like completely gorgeous. And this guy's in his 60s. He's wider than he is tall, completely bald. And, I just didn't know what to think of this guy other than like, man, I'm kind of starting to idolize this guy. This guy is like maybe my hero. I don't know. I've never had a hero before, but he could be it, And so then as I continued to work for him, I saw the dark side of what becoming a billionaire can be. And as the onion peeled back and I got to know him more, I realized, wow, this guy's miserable. His wife hates him, shocker. His daughters won't talk to him. And he's hanging around with me, building a relationship with this 22-year-old kid that doesn't know anything. Is just a 22-year-old kid, looking for some beer money, right? Because he has no one else to go to, no one else to talk to. And so on one hand, I got this is a guy. This guy puts on one pant leg at a time. He's just a guy, like an American dude can do this. If he can do it, I can do it. I can become a billionaire. And then on the other hand, to get that experience of what that cost potentially could be, robbed of all joy, robbed of your family. So I had this experience, and then the gig ended. The 2 weeks was over. I flew back in town, and at like 2:00 in the morning, I got back and I started my corporate America job, my college job, the very next morning. And I got there and I literally knew within an hour of being at the place, corporate America is not for me. I need to do my own thing. I have to run my own business. And as I built up for it, I did my first real estate deal. I got in. I made a promise to myself that I'm going to strive and go after that $1 billion enterprise. And I'm going to weigh the success by what I gave up to get it. Wow. So really the goal of what I'm trying to do on the Making Billions is to have that joyful environment for my kids the way I had it, the way many middle-class people have, like the downside of building an enterprise, right, could be a tremendous cost. And so I have that in mind going into it. And the only way I've been really able to achieve this so far, and as the business continues to grow, I constantly have to battle this, is I'll work 80 hours a week and not even care because I'm building something. I have fun with it and I'm solving problems, right? What I learned from a mentor is to not just do a business vision. So the business vision is one component of it, but what about a personal life vision as well? So if you do a personal life vision first and figure out who you are as a person, what you want your family life to be like, right? Then stack on top the business vision. And that business vision, by the way, needs to serve the personal vision. If it doesn't, then the business strategy needs to change because you said hey, this is the vision for my life and what I want to do. So that's been an amazingly important thing that I've implemented and that I'm really proud. I coach my daughter's softball team. I coach my son's baseball team. I go to almost all their games. And it's not that I don't have different seasons. This year I'm in a season of work. I sat down with my wife. I said, I'm going to work more than I have the last couple of years because we're at a tipping point in our business. It's getting ready to explode and it's just going to take an extra lift this year. Are you willing to be in that with me? And she agreed. Now the only agreement though that I have in my head is I'm going to be there for dinner time. If my wife needs some help with picking up a kid or something like that, that's great. And maybe I'm working at 10 o'clock that night after the kids go to bed because I'm in a sprint right now. But I'm going to look at my personal life with the same regard, the same goal setting, the same intention as I do my business. And that's the only way I've been able to let go of feeling guilty that I'm not working and building my business when I'm at home, and then being at work and feeling guilty that I'm not as present as I need to be with my kids. I'm sure as entrepreneurs, everybody's had that feeling where it's like you're not fully present in either world, right? Where I took my personal life and I said, no, okay, this is a weekend. My intention and my goal is to be a dad today, and I need to achieve that today. Just the same way, I'm trying to make a sale. And it's a little bit strange of a way to look at it. I think most of the population that's entrepreneurs, a lot of y'all listening get it. I know you do. But that has worked at such a high level for us. It's a way to avoid burnout. I had coffee with an individual that he has a very successful business that runs culture for a Fortune 500 company that is known for culture. I didn't even know this company outsourced culture, but his company runs it for this entire airline. And he told me, he said, hey, I have a lot of friends. One of my buddies is worth over $500 million. And he's completely burned out. He's absolutely miserable. He doesn't feel like he has any friends. And he doesn't have a relationship with his kids or his wife. And he literally would give it all away to have more friends and to have the connection with his family. He would literally write a $500 million check if he could do it. And unfortunately, the bridges have been burned and he can't.
Yeah, that is a powerful, powerful final note. So I'll have a few comments on that. But before we close everything out, is there anything else that you'd like our fans around the world to know? Anyway, if they can reach you or anything at all.
Yeah, absolutely. So a big part of like why I'm getting on podcasts is to just provide value for people. It's one of the best things about you, Ryan. You're very much a giver. You try and provide value. And so if you go to jimmanning.com, I have a lot of great gifts for you. I spent hours and hours and hours researching the real estate market. I have a free white paper on there. In 2022, we generated millions of dollars of passive income using 3 strategies. I have a free course on that. If you're interested at all in investing in real estate funds, I have a course on that that's very comprehensive that can teach you how to analyze different funds and look out for different risk structures. There's also information if you have an interest in investing in real estate and want to learn more about our funds. So just go to jimmanning.com. And there's a whole lot of capital out there, right? So the goal of it is like, I just want to provide value and I want to help. And if the stars line up where we have some deals and somebody has some capital, great, we can do some things. But if not, if I can equip you to be a smarter passive investor, to know what to look for, to know what some of the risk factors are, to allow them to do other deals like without me. I don't care. I just want to help them provide value. So we are going to have a cost to them on my main podcast, but Ryan, for you as a gift to the Making Billions community, if you go to that jimmanning.com, you can get it all for free, and you don't have to pay it's about $2,500 worth of stuff and just put in your name and your email and have fun with it, guys.
Awesome. Wow. Thank you, man. That's very generous. So just to recap everything, I want to mention something. I'm going a little off script. That story you mentioned of the billionaire, I think there are a ton of lessons all summarized from literally every episode I've done in this show. Comes down to this. There is a difference between being rich and being wealthy. While both rich and wealthy people have a lot of money, you got to be very careful on the goal you set. I would challenge you, anyone listening to the sound of my voice, do not set a goal to just be rich. Nothing wrong with that. But I think if you're listening to this show, you're looking for a little bit more. Instead, while rich people have a lot of money, wealthy people have an abundance of life. Wealthy people have an abundance of relationships and capital and time. And they take that capital and reinvest it in improving relationships and saving their time. And so I would challenge all of you, don't just set a goal to be like that guy who's made all that money, wildly rich. But unfortunately, with all that money, he never achieved real wealth, did he? With all of that money, he was ready to give away his riches because he, like many of you, climbed that ladder, reached the top only to realize he leaned it against the wrong wall. And I've been there. And maybe many of you listening to it are there right now. So my challenge to you, all of you listening to me right now, is remember that real wealth is in a family that will talk to you, right? Or whatever those relationships are. Maybe it's not family. Maybe it's friendship. So remember, it's not enough to make billions just in capital, but make sure what you do with it improves the relationships around you. It improves the time that you spend. And so the easiest way I've always found, I'm a big fan of investment funds, is you want to own assets or companies that other people run. Be an owner, not an operator. That is how you go from just being another rich guy to someone who's wildly wealthy. Tons of capital, love all around, great friends, impeccable reputation, and a wonderful set of relationships. You do these things, and you too will be well on your way in your pursuit of making billions.